In this video, we're going to discuss how to start investing in the stock market as a beginner. If you're ready to start investing in the stock market, but aren't sure how to get started or which stocks to choose, you've come to the right place. There are a few characteristics of stocks that are good for beginners, as well as some practices beginners should specifically avoid when selecting the first companies for their portfolios. Here's a rundown of 7 things every beginner investor should look for and stay away from when choosing your first stocks, as well as a few examples of excellent beginner-friendly stocks to help get your search started. Number 1, define your investing goals. Your investing goals and risk tolerance will help you decide which stocks to buy and at what price. Think about what you want to do with your money: buy a house, generate income, build wealth for retirement, save for your kids' education, or just collect some money for a rainy day. Determine how much time you have left to achieve your goals after that. A general rule of thumb is that you shouldn't invest in stocks with money you'll need within the next 3 to 5 years, and longer time horizons, or even better. The stock market can fluctuate quite a bit over shorter periods. So before you invest, be sure you understand your risk tolerance and that you're mentally prepared to ride out the ups and downs. Are you going to be a hands-on or passive investor? A hands-on investor builds a portfolio by choosing investments either alone or with a financial advisor's help. This option offers more control over the portfolio structure and appeals to individuals looking to maximize gains. It is also more time-consuming for the person who has to research the available investment choices. A passive investor doesn't choose individual stocks. Instead, they match the performance of specific market indexes, like this S&P 500 or Dow Jones Industrial Average. This approach tends to lessen volatility and provide a more stable return over time, but it comes with less growth potential. Number 2, open an investment account. Before you start investing in stocks, you'll need to open a brokerage account. Once you determine your investing approach and how much money you can invest, you'll need to open an account to buy and sell shares of companies or whatever other assets you'd like to invest in. A full-service brokerage, also known as a traditional brokerage, offers additional services beyond just buying and selling stocks, such as investment advice, wealth management, and estate planning. Typically, full-service brokerages provide the services at high overall costs, while discount and online brokerages maintain scaled-down services with lower overall costs. Online brokerage and online brokerage account is ideal for most beginning investors looking to have a hands-on approach to trading stocks and building a financial portfolio. If you feel confident or curious about how to start investing at a lower cost than a full-service brokerage firm, opening an account with an online broker could be a great place to start. Robo-advisor. If you're interested in investing but want some help setting up a basic portfolio, opening an investment account with a robo-advisor might be best for you. A robo-advisor uses a sophisticated computer algorithm to help you pick and manage investments. These automated accounts generally don't offer individual stocks. Instead, they build a portfolio with a mix of exchange-traded funds ETF. Nonetheless, it's a way to become more familiar with investing retirement accounts. Retirement accounts, like employer-sponsored 401ks or individual retirement accounts. IRAs are tax-advantaged investment accounts that can be great for the beginning investor trying to build a retirement nest egg. These accounts offer investors a range of investment choices, including individual stocks. You may also have access to tutorials, advisors, or other resources to help you learn how to start investing in these accounts. Number 3, look for stocks with a wide moat when investing. You might hear experienced investors talk about the concept of a wide moat, especially if you're reading anything about Warren Buffett's investment style. A sustainable competitive advantage will prevent competitors from taking a company's market share in the same way that a wide moat around a castle makes it difficult for enemies to invade. A benefit of this kind can manifest itself in a variety of ways, but it is not overly difficult to identify them if you are aware of what to search for. This is the kind of moat that a good investment for beginning investors will have. Number 4, understand basic metrics. Knowing how to identify great businesses is more important than being able to identify cheap stocks. A great business will typically be a good long-term performer even at a bit of an expensive valuation. On the other hand, a bad business you invest in at a cheap valuation will seldom work out well. Once you've learned how to find good businesses, some basic stock investment metrics can help you narrow them down. P/E ratio, the price-to-earnings ratio, is the most widely cited valuation metric. Simply divide a company's current share price by its past 12 months' worth of earnings. PEG ratio, the price-to-earnings growth ratio, levels the playing field for P/E shortfalls. Simply divide the company's P ratio by its projected earnings growth rate. Payout ratio, the payout ratio measures the annual dividend rate expressed as a percentage of its earnings, which sheds light on dividend stability. For example, if a company paid out $1 in dividends per share last year and earned $2, it has a 50% payout ratio. Number 5. Decide what types of stocks to invest in. Purchasing stock directly from a company isn't the only way to invest in stocks. Investors can also choose between mutual funds, index funds, and exchange-traded funds. Number 6, manage and diversify your portfolio. The key to success as an investor also depends on your ability to lessen the risk by researching the investments that best meet your needs, diversifying your portfolio, and keeping track of its performance. Here are some tips on how you can create a diversified portfolio. Choose a mixture of stocks, bonds, and other short-term investments that match your investment goals and risk tolerance. Meet with a financial advisor regularly, such as every 6 to 12 months, to review and evaluate your investment's performance. Change your asset allocation as you get closer to retirement if you're falling short of your financial goal. Stock prices will rise and fall in reaction to factors you cannot control. But taking steps to manage your portfolio, either on your own or with assistance, can help you reach your financial goals. Number 7, know which stocks to avoid. Investing in the wrong type of stock can make your portfolio's value look like a roller coaster and can even cause you to lose your entire investment. With that in mind, here's what you'd be wise to stay away from at first: rapidly growing companies. This is especially true for companies that have yet to turn a profit. Growth investing can be a great way to build wealth, but it can be volatile. It's a good idea to wait until you build up a base for your portfolio and understand stocks better before you try to invest in the next big thing. Penny stocks, loosely defined as stocks with a market value of less than $200 million. Share prices of less than $5 or don't trade on major exchanges. Penny stocks should be avoided by all investors. So, these are the 7 things that beginners should know and avoid these companies before they select their first stock. Alright, I think this video is helpful to learn about stock market investing tips, and if we did, make sure to subscribe the channel and turn on the bell notification. See you in the next video.